Hey everybody. In this video I'm just going to quickly go over how to um, trade in the money options, like how to select them and how to calculate your risk and all that. So a great way to trade um, stocks like their stocks rather than options is to use in the money options. When you trade out of the money, you can be correct about the direction and still lose money if it doesn't move as fast as it needs to. Whereas with in the money options, the deeper you go, um, the more correlated they are to the actual stock price. So, if you have out the money puts on Royal Caribbean and it moves down 50 cents, you might not make that much percentage wise because you have way out of the money puts. So it has to move down a lot in order to make you money. Whereas if you have something in the money, deep in the money, even like a 55 put, you're going to be making money for every 10 cents that it moves down. So if you go to next week and you go to like the 55 puts, the delta's 77. So every dollar that Royal Caribbean moves down or up, you're going to be making or losing $77. Plus, you're losing $11 a day to theta. And then, another variable is volatility, which if the stock, is going flat, you're going to be losing value there as well. So if the stock just went completely flat, you'd be losing theta, which is $11 per day or 11 cents on the option, plus volatility, which is can be quite a big hit. So basically, if you were to buy this 55 put and get it for 850, let's say, or let's just say in the middle 830. If this stock went against you two deltas, it's gonna be against you about 160 plus a day, 170 maybe. So you're gonna be down about 20%, less than 25% of your position if this thing goes against you $2. So that compares to being down 40, 50, even 75% on out of the money options. So here it's a bit safer, but there's still just as much risk involved. So that's just something that you need to watch. And if you like trading stocks and you're more used to that, and you can't get used to the out of the money options, just try out these in the money. I mean, you can even go with the 52 strike, which has 250 plus 2 has $450 intrinsic value, and then the time and the volatility and all that is the rest of that. So 450, and then the other $1.25 or so is just time value and volatility and all that. So the deeper you go in the money, the less time value and volatility value that's going to be in the trade. So if you look here, this thing has $7.50 of intrinsic value because it's $7.50 in the money, and it's trading at probably, let's say, 8.30. So it really only has $80 of time value and volatility value, which is a very small percentage compared to the other trades. So that's just something you should watch for. And these in the money options are a lot more they're a lot easier to handle and understand, whereas the out of the money options can be very complicated and you can lose money even when a stock is going your way. So if you just want to take a simple approach and get some leverage on your money, and you just want to get started and try to learn to trade, you can use in the money options to leverage your money but not be too risky.